Welcome back to the Deep Dive.
Great to be here.
Today we're really plunging into something absolutely critical for anyone serious about algorithmic trading.
Yeah, something foundational.
We're talking about mastering robust backtesting, specifically for swing trading strategies.
It's a big topic, and getting it right is, well, everything.
Our mission here, as always, is to cut through the fluff. We're digging into a comprehensive guide covering techniques, those common pitfalls, advanced tools, basically everything you need.
The idea is to pull out the most important insights. How do you build trading systems that are actually resilient?
Exactly. Systems that work in the messy reality of the live market, not just, looking good on a perfect historical chart.
Which is the dream, right? But it takes work. The source material really hammers this home. Backtesting isn't optional. It's indispensable.
It's your lab, essentially, your chance to pressure test a strategy idea with historical data before a single dollar of real capital is at risk.
It's that essential validation step. Does this idea actually have an edge, statistically speaking?
And we need to stress the word robust. That's the core concept we're chasing today. It's not enough for a backtest to just show past profits.
Not at all. A robust backtest confirms the strategy has resilience, stability, the qualities needed to handle the unpredictable nature of live markets.
Okay, and before we dive deeper, if you're finding this valuable, please take a moment to like, share, and subscribe. It really helps us continue these deep dives.
Definitely appreciate the support. So yeah, robustness, it's about building something that can actually stand up in the real world.
Which means we have to talk about the traps, like overfitting, getting fooled by historical data, or forgetting about real-world trading costs.
Huge ones. Ignoring those can sink a strategy that looked amazing on paper.
So think of this as your roadmap. We're aiming to walk you through developing strategies geared towards consistent, sustainable trading success. We'll hit the pitfalls, the best practices, the tools.
Let's start maybe by drawing a really clear line between two fundamental ways people approach trading. It helps frame why backtesting is so vital.
Good idea. Let's contrast discretionary trading with systematic backtesting.
Okay, so discretionary trading, it's all about the trader's judgment in the moment, right?
Yeah, it relies heavily on their experience, their real-time analysis, maybe a gut feeling about a chart pattern or how they interpret news.
It's flexible, definitely.
Yeah.
You can adapt on the fly. But the big downside is subjectivity. It's so tied to human emotion, bias.
We've all been there, feeling overly confident after a win streak or maybe revenge trading after a loss. That's the human element messing things up.
Exactly. Backtesting, though, forces you to be precise. You have to define concrete rules for everything.
When to enter, when to exit, how much to risk.
Every single detail. And then you take those hard rules and systematically, almost mechanically, apply them to historical data.
That systematic application is the absolute game changer, isn't it? It strips out the emotion.
Completely. The rules make the decisions, not your feelings that day. You get perfect consistency in applying the logic.
So while, discretionary trading might work for some really experienced traders with amazing intuition.
And nerves of steel, maybe.
Right. But it just lacks that rigor, that repeatable, objective analysis you get from backtesting.
And for algorithmic trading, where the whole point is to automate decisions based on predefined criteria, that data-driven, evidence-based foundation from backtesting is non-negotiable. You need proof, not just a hunch.
Okay, so we've established why backtesting is the cornerstone for algo trading. Now, let's get into how people actually do it. Because, as our source makes very clear, not all backtesting methods are created equal.
Not even close. Some methods are, frankly, dangerous because they can give you a totally false sense of confidence.
Right. We can basically group them into three main types, sort of going from least reliable to most reliable, though the most reliable still has a major catch.
Let's start with the one that probably trips up the most beginners, the easiest trap to fall into.
Visual inspection of chart indicators. Sounds simple enough.
Deceptively simple. So, what is it? You pull up a chart, maybe slap on a moving average crossover or an RSI indicator.
And you just scroll back through history.
Yeah, you scroll back and you spot instances where, say, the average is crossed and then the price shot up. Or where the RSI hit, oversold, and then the price bounced nicely. You visually infer that this looks like it works.
Ah, so you're basically cherry-picking the good-looking examples after the fact. Hindsight bias.
Exactly. You're ignoring all the times the crossover happened and price went nowhere, or went down, or the RSI bounced but then kept falling.
The danger here sounds immense. It's totally subjective.
Hugely subjective. What looks like a clear signal to you might look like noise to someone else. and it's prime territory for confirmation bias. Your brain wants to see patterns that support your initial idea.
And crucially, it tells you nothing about actual performance over hundreds of trades, right? Like average win-loss, frequency, costs.
Zero. You see that one beautiful trade setup, but you have absolutely no quantitative data on whether that pattern was genuinely profitable over, say, the last 10 years, considering all the false signals, the whipsaws, the transaction costs. Nothing.
And the outcome for the trader. Massive overconfidence in an untested idea, leading almost inevitably to disappointment or losses in live trading.
Pretty much guaranteed. So visual inspection. Avoid it like the plague for serious strategy validation.
Okay, moving up a notch in rigor, but still flawed. Bar replay testing.
Right. This is a step up because you are actually simulating trades in a more structured way.
How does it work? You're replaying price bars one by one.
Yeah. Platforms let you replay historical data bar by bar as if it's happening live.
Right.
You manually decide to enter or exit trades based on your predefined rules as each new bar appears.
So you are applying rules consistently, which is better.
It is better than just eyeballing. But the flaws are still pretty significant.
Time-consuming, I imagine.
Incredibly manual and slow. Think about trying to test 10 years of daily data across multiple stocks this way. It's just not practical.
And that limitation on testing time, that leads back to our big enemy, doesn't it?
Overfitting, yes. If you can only manually test a relatively short period, maybe a year or two, how do you know if the strategy's success wasn't just because of the specific market conditions during that one limited window?
It might have worked great in that particular bull run you tested, but falls apart in chop or a downturn.
Precisely. You lack the breadth of data to see if it holds up across different market regimes. Plus, manual replay makes it really hard to accurately simulate things like realistic position sizing if you have multiple signals firing across different instruments at the same time. It just doesn't scale.
So better than looking, but still not robust enough for serious algorithmic development.
Not really, no. Which brings us to the method that offers the most potential, but also harbors that notorious trap we keep mentioning: programmatic backtesting.
This is the standard for serious algo traders, right? Using dedicated software.
Yes. This involves actually coding your strategy's rules, the entry signals, exit rules, risk management into a backtesting platform. Think TradingView, Amibroker, NinjaTrader, Python libraries. There are many options.
Oh, the platform does the heavy lifting. Runs the rules across history automatically.
Exactly. It crunches through years, even decades of historical price data, executing trades according to your precise rules.
The advantages seem obvious, systematic, repeatable.
Perfectly repeatable. And it generates objective performance metrics, hard numbers.
Like what? What kind of stats do you get?
All the key stuff. Total profit, profit factor, maximum drawdown, win rate, average win, average loss, number of trades, equity curve, a whole suite of quantitative measures telling you exactly how those rules performed historically.
This is what you need for building algos. Data-driven decisions.
Absolutely essential. But, and this is the big but,
Here comes the catch.
overfitting, the primary danger, the silent killer, with programmatic backtesting.
Explain that again. How does it happen here, even with all the data?
It happens when you start tweaking your strategy's parameters. You know, the specific settings like the length of a moving average or the threshold for an RSI signal or a stop loss level. You tweak them over and over again, optimizing them to produce the absolute best possible results on the specific historical data you're testing on.
So you're fine-tuning it too perfectly to the past.
Exactly. You inadvertently create a strategy that's perfectly tailored to the unique noise, the specific quirks, the random patterns within that historical data set. It looks phenomenal in the backtest.
But then you take it live.
And it collapses.
Yeah.
Because the live market is new data, it has different nuances, different noise. Your perfectly fitted key no longer works on the new lock.
It's like memorizing the answers to one specific old exam paper perfectly, but being unable to answer questions on the actual test.
Excellent analogy. So the absolute number one goal when developing robust systems using programmatic backtesting must be actively fighting overfitting. You have to assume it's a risk and build in defenses.
Ignoring it is basically guaranteeing failure down the line.
Pretty much. So how do we combat this? What are the key strategies our source highlights for detecting and mitigating overfitting?
Okay, let's break those down. What's the first line of defense?
Probably the most crucial. Use a long backtest period that spans multiple distinct market cycles. Meaning your historical data absolutely must include periods of strong bull markets, significant bear markets or crashes, and also extended periods of choppy, sideways, range-bound action.
You need to see how the strategy behaves in all conditions, not just the easy ones.
Precisely. If your strategy looks like a superstar but was only tested during, say, the 2010-2019 bull run, it's almost certainly overfitted to buy the dip environments and will likely get destroyed when real volatility or a downturn arrives.
Yeah.
You need to stress test it.
Makes sense. What's next? Sample size?
Yes. Critically important. You need a statistically significant number of trades in your backtest. The source strongly recommends a minimum of 100 trades.
Why 100? Why is that number important?
Because if your fantastic results are based on only, say, 15 or 20 trades over 10 years, it's highly probable those results are just due to random chance or luck, a few fortunate entries or exits.
Not indicative of a real, repeatable edge.
Exactly. Getting 100, 200, or even more trades gives you much higher confidence that the performance metrics you're seeing, like the win rate or profit factor, are statistically reliable and represent a genuine characteristic of the strategy, not just noise.
So long period, multiple cycles, and enough trades for significance. What else?
Test your strategy logic across multiple, preferably diverse, instruments and maybe even different timeframes.
So don't just test it on Apple stock on the daily chart.
Right. A truly robust strategy concept, if the underlying logic is sound, shouldn't only work on one specific symbol using one specific time frame. Try it on other stocks, maybe some indices, perhaps even Forex pairs or commodities if the logic could apply.
And maybe try the daily and the 4-hour chart?
Potentially, yes. If it shows reasonably consistent positive performance across different assets and time frames, it suggests the edge is more general, less likely to be an artifact of the specific price history of just one thing. It's a check for generality, which fights overfitting.
Okay, testing generality. What else helps keep us safe?
Keep it simple. Simplify your strategy. This is huge.
Less is more.
Often, yes.
Yeah.
Strategies that are incredibly complex with dozens of rules and, crucially, dozens of parameters, inputs like indicator lengths, thresholds, filter values that you can tweak and optimize, they're exponentially more prone to overfitting.
Why is that? More knobs to turn.
Exactly. Every parameter you add and then optimize gives you another degree of freedom to accidentally curve fit your strategy to the historical noise, rather than capturing a genuine, simple market edge. Our source strongly advises against optimizing too many parameters. Focus on the core logic.
Fewer parameters, less opportunity to fool yourself with optimization.
That's a good way to put it. Finally, actively use specific robustness checks. These are tools and techniques explicitly designed to probe the stability of your chosen parameters.
To see if your optimized settings are solid or just balanced on a knife edge.
Precisely. They help you differentiate between parameters that are likely to hold up in new, unseen data versus those that are likely overfitted historical flukes.
And our source highlights a particularly powerful visual tool for this, especially in platforms like Amibroker, 3D stability graphs.
Yes, these are fantastic. Amibroker is well known for this feature, and it's a potent weapon in the anti-overfitting fight. It helps you see the stability or lack thereof.
Okay, kind of picture for us. How do these 3D graphs actually work?
Imagine your strategy relies on two key parameters you want to optimize. Let's stick with the classic example. The lengths of a fast and a slow-moving average for a crossover system.
Okay, like a 50-day and a 200-day, but maybe we want to test variations around those.
Exactly. The 3D stability graph will plot your chosen performance metric. Maybe it's profit factor, maybe RMDD, something robust on the vertical z-axis.
So height represents performance.
Right. And on the two horizontal axes, X and Y, you'll have the range of values you tested for your two parameters, say, the fast MA length on one axis and the slow MA length on the other.
So it creates a kind of performance landscape or surface.
Precisely. You get this 3D surface showing how well the strategy performed for every combination of those two parameter values you tested.
And the key is interpreting that landscape for robustness.
Absolutely. What you are desperately hoping to find are broad, relatively flat regions on that surface plateaus.
Plateaus, meaning areas where performance is good but doesn't change drastically if you tweak the parameters a little bit.
Exactly that. If you find a nice plateau, it signifies stability. It means that small changes in your MA lengths within that zone don't cause the strategy's performance to collapse. This suggests the performance isn't hypersensitive to those exact values. It's more robust.
That's where you want to choose your parameters from, somewhere in the middle of a stable plateau.
Yes. Avoid the edges, pick from the stable middle. Conversely, the massive red flag, the sign of dangerous overfitting, is seeing sharp, isolated peaks on that graph.
Like a single mountain spike.
Exactly. Where performance shoots up dramatically for one or maybe two very specific combinations of parameters, but plummets if you change either parameter even slightly.
That screams fluke, right? Overfitted to noise.
Absolutely. Those peaks are traps. They represent parameter sets that worked perfectly on the historical data by chance, but have almost zero chance of working going forward. You must avoid selecting parameters from those sharp peaks, no matter how high the historical performance looks there.
This really reframes the whole concept of optimization, doesn't it? It's not about finding the single highest point on the graph anymore.
Not at all. That's the beginner's mistake, chasing the peak. That leads straight to live trading failure. True, robust optimization, as our source emphasizes, is about refining your parameters to find the most stable region.
You're looking for consistency and resilience, not just the highest historical score.
Precisely. You prioritize performance that holds up across a range of similar parameter values, which you find on those plateaus. You're managing risk by choosing stability over potentially fleeting peak performance. The 3D graph is just invaluable for visualizing that stability.
Okay, so you're using these tools like 3D graphs, you're using long data, multiple cycles, enough trades, testing generality, keeping it simple. You're actively fighting overfitting. The next critical piece is what performance metric you actually aim for during that optimization process.
Yes, the choice of optimization metric is fundamental. It directly shapes the kind of strategy you end up with, its characteristics, its risk profile, its likely stability.
And the source warns that some common metrics people intuitively optimize for can actually be quite misleading.
Very true. Many traders naturally gravitate toward optimizing for the highest total profit or the highest win rate, but optimizing solely for these can lead you astray.
Let's unpack those. What's the problem with optimizing just for win rate? That sounds good, winning often.
It sounds appealing, right? Who doesn't want to win 80% or 90% of their trades? But the danger is that optimizing only for win rate often leads to strategies that capture lots and lots of very small wins, but are susceptible to occasional very large losses. The small wins get you the high win rate, but the few large losses can wipe out all those gains and more. The strategy might be fragile.
So you win tons of tiny battles, but get crushed in the few big ones you lose. The overall result isn't good.
Exactly. High win rate doesn't automatically mean profitable or robust.
Yeah.
Then there's optimizing for total return, just the overall profit loss number.
What's the issue there? Isn't total profit the goal?
Well, yes, ultimately. But optimizing directly for the highest possible total return ignores the path taken to achieve that return. It ignores the risk involved.
Meaning?
A strategy could show a spectacular total return in a backtest, but it might have achieved that return by enduring absolutely terrifying drawdowns along the way, maybe 50% or 60% peak-to-trough losses in account equity.
Ouch. So the end number looks good, but the ride was unbearable and potentially ruinous.
Exactly. Optimizing for total return alone gives you no information about the volatility or the risk exposure required to get that return. You might end up with a strategy you psychologically can't even trade live because the swings are too wild.
Okay, so if win rate and total return are potentially flawed targets for optimization, what should we be optimizing for? What gives a more balanced view?
Our source highlights two metrics that are generally considered superior because they explicitly incorporate risk alongside reward: profit factor and CAR-MDD.
Let's start with profit factor. How's that calculated and why is it better?
Profit factor is pretty straightforward. You take the total gross profit from all your winning trades and divide it by the total gross loss from all your losing trades.
Okay, total wins divided by total losses.
Right. It directly measures how much your winners make relative to how much your losers cost. A profit factor of 1 means your wins exactly equal, your losses break even, essentially. Anything above 1 means you're profitable.
And what's considered a good target?
The source suggests aiming for a profit factor significantly above 1. Ideally above 1.5 or even higher for swing trading strategies. A higher profit factor indicates a healthier edge. Your winning trades are substantially larger or more frequent than your losing trades. It's a balanced measure of profitability relative to losses incurred.
Got it. It measures the strength of the edge. What about the other one? CAR-MDD. Sounds like an acronym soup.
Yeah. Stands for compounded annual return divided by maximum drawdown.
Okay, break that down. CRR.
Compounded annual return.
Right.
It's basically the average annualized rate of return your strategy achieved over the backtest period, assuming profits are reinvested. It tells you the growth rate.
And MDD?
Maximum drawdown. is a key risk metric. It measures the largest percentage drop your account equity experienced from a peak down to a subsequent trough during the backtest. It represents the worst historical pain point or capital erosion.
So CAR-MDD is essentially return divided by the worst risk experienced.
Exactly. You're looking at how much annual return you got for each unit of maximum historical drawdown risk you had to endure. A higher CAR-MDD ratio is very desirable.
Why? What does a high ratio tell you?
It suggests a strategy that generates good, consistent returns relative to the capital risk and volatility involved. It implies smoother equity growth with more manageable bumps along the road. It's a great measure for balancing profitability with risk tolerance.
So the practical advice here, the pro tip, is optimize for profit factor or CAR-MDD, not just win rate or total profit.
Yes. Our source gives a really good illustration. Imagine strategy A has an 80% win rate, but only a profit factor of 1.2. Strategy B has a lower 60% win rate, but a much healthier profit factor of 2.0.
Well, which one is likely more robust?
Strategy B, almost certainly. That 80% win rate strategy is likely winning tiny amounts frequently, easily erased by the larger losses indicated by the low 1.2 profit factor. Strategy B with a profit factor of 2 is making twice as much on its winners as it loses on its losers, on average. That's a much stronger, more durable edge, even if it wins less often.
So focusing on these risk-adjusted metrics during optimization is key to building something sustainable.
Fundamental. It steers you towards strategies that balance reward with manageable risk.
Okay, so let's recap the core pillars for a robust backtest again, just to nail them down. We need
minimum 100 trades for statistical significance.
Got it. Yeah.
A long backtest period covering multiple market cycles, bull, bear, sideways, to test adaptability.
Check. And the third?
Testing across multiple instruments and potentially timeframes to confirm the strategy's logic is general and not just a quirk of one specific data set.
Right. Those are the foundations. But even if you do all that, optimize for stable parameters using good metrics. How do you really simulate how the strategy might adapt over time in the real world? Markets change.
Excellent point. That's where another advanced technique comes in when our source emphasizes walk-forward analysis and optimization, often called WFO.
Walk-forward optimization sounds dynamic. How does that work?
It's designed specifically to mimic how a trader might periodically reevaluate and potentially reoptimize a strategy as new market data comes in, but in a structured, out-of-sample testing way.
Okay, step by step, what's the process?
You take your historical data and divide it into chunks. First, you select an initial in-sample period, let's say 5 years of data, maybe 2010 to 2013.
Yeah.
You optimize your strategy parameters only on this 5-year block.
Find the best stable parameters for that specific historical window.
Exactly. Then you take those exact optimized parameters without changing them, and you apply them to the next chunk of data, the out-of-sample period, which the optimization process never saw. Maybe that's the following 2 years, 2015 to 2016.
So optimize on the past, test on the immediate future.
Right. You record the performance on that out-of-sample segment. Then comes the walk-forward part. You slide both windows forward in time.
How far forward?
Depends on the strategy and data, but maybe you slide both windows forward by 1 year. So now your new in-sample period is 2011-2015. You re-optimize parameters only on this new 5-year block.
Get potentially different optimal parameters because the data is different.
Potentially, yes. Then you take these newly optimized parameters and test them on the next out-of-sample period, which would be 2016-2017. Record that performance.
And you keep repeating this process, sliding the windows, re-optimizing in-sample, testing out-of-sample, all the way through your historical data.
Exactly. You end up with a series of performance results purely from the out-of-sample periods.
Why is this considered such a critical test? What does it really tell you?
It's powerful because it directly tests the adaptability of your strategy and your optimization process. It simulates a realistic scenario of periodically updating your strategy based on recent history, and then seeing if those updates hold up on truly unseen future data.
So if the strategy consistently performs well across all those different out-of-sample segments during the walk-forward test?
It provides much stronger evidence that the underlying strategy logic is robust and adaptable to changing market conditions, and that your optimization process is finding parameters that generalize well, rather than just being overfitted to one static historical period. It's a very rigorous test of real-world viability.
Okay, WFO adds another layer of confidence and adaptability, but there's still a very practical elephant in the room. Real-world trading costs. Things that don't show up unless you explicitly account for them.
Oh, absolutely. Transaction costs. Often underestimated, especially by newer traders or those moving from, say, paper trading or simpler backtests. These costs can significantly eat into profits.
And if your backtest doesn't include them, your results are fundamentally unrealistic.
Completely unrealistic. You absolutely must factor them in for any meaningful backtest.
What are the main costs we need to simulate?
The big three are usually slippage, spreads, and commissions.
Okay, define those quickly. Slippage.
Slippage is the difference between the price you expected your trade to execute at and the price you actually got filled at.
Why would that happen?
Market volatility price moves between when you send the order and when it fills. Or low liquidity, not enough buyers or sellers at your desired price, so you get filled at the next available price, which might be worse. It can happen on entry and exit.
So you click buy at $100, but maybe you get filled at $100 at 2 cents. That 2 cents is slippage cost.
Exactly. Then there are spreads, the bid-ask spread.
The difference between the buy and sell price shown.
Right. The bid is the highest price someone is willing to pay, where you sell. The ask is the lowest price someone is willing to sell at, where you buy. The ask is always higher than the bid. That difference, the spread, is an immediate cost you pay on every round-trip trade, just for crossing it.
And finally, commissions.
Yep, the fees your broker charges for executing the trade. Could be per trade, per share, or some other structure.
How much impact do these have? Does it vary depending on the strategy?
Hugely important point. Yes, it varies significantly. For a longer-term swing trading strategy using daily charts on very liquid stocks or ETFs, the slippage and spread cost per trade might be relatively small.
But still needs to be included.
Absolutely, they add up over hundreds of trades. But where these costs become absolutely critical, as our source emphasizes, is on smaller time frames.
Like 1-hour charts, 15-minute day trading.
Exactly. On those shorter time frames, your average profit target per trade is often much smaller. Maybe you're aiming for just 10 or 20 cents profit.
And the spread and potential slippage could be a significant chunk of that.
It could be a huge percentage, or even wipe out the potential profit entirely. A strategy that looks incredibly profitable on a 15-minute chart backtest without costs included might actually be a consistent loser once you factor in realistic spreads and slippage for every single trade, especially in less liquid markets where spreads widen.
Wow. So ignoring costs on shorter timeframes is basically guaranteeing a nasty surprise when you go live.
A devastating surprise, potentially. So the pro tip, the absolute rule here, always include realistic estimates for slippage, spreads, and commissions in your backtests, especially if you're trading frequently on smaller time frames or in assets that aren't super liquid. It's non-negotiable for reliability.
Okay, that's crystal clear. Now, one final layer of realism. Most traders aren't just trading one thing, they manage a portfolio. Does standard backtesting capture that?
Often, no. Standard backtesting frequently focuses on applying a strategy to a single instrument in isolation. But that's not how most people trade in reality.
You might have positions in 5 or 10 different stocks simultaneously, all potentially generated by the same strategy rules.
Exactly. And that's where portfolio-level backtesting becomes essential for a truly comprehensive picture.
What does that involve?
Platforms like Amibroker and others allow you to run your strategy rules across an entire portfolio or universe of instruments simultaneously within the backtest.
So it simulates managing the whole basket of potential trades.
Yes. It has to account for crucial real-world complexities that single instrument tests ignore. Things like, how is your limited trading capital allocated when multiple signals trigger at once across different stocks? How does your position sizing model work at the portfolio level? For example, risking 1% of total equity per trade. How do the correlations and diversification effects between different positions impact the overall portfolio equity curve and drawdown?
So it's looking at the combined performance and risk of all the strategies' trades together as they would occur in a real account.
Precisely. It simulates the actual management of the portfolio. Why does this matter for robustness? Because ultimately, your success is determined by the performance and risk profile of your entire trading account, not just one stock's P&L in isolation.
Portfolio-level backtesting gives you that vital, holistic view. It helps assess the overall risk-adjusted return of the strategy when applied realistically across your intended trading universe.
It's the final layer of simulating reality before you consider going live.
Okay, so let's try and pull all these threads together. We've covered a lot of ground.
We have. And the big takeaway is that robust backtesting is so much more than just running some code. It's a meticulous process, a mindset almost, focused on building genuine confidence and aiming for consistency.
It starts with understanding the different methods, visual, bar replay, programmatic, and knowing their flaws, especially the subjectivity and overfitting risks.
Then it's about actively fighting that overfitting, using long historical periods with multiple market cycles, demanding a statistically significant number of trades, like 100 plus up,
Testing for generality across different instruments and timeframes, keeping the strategy itself relatively simple, avoiding excessive parameter optimization.
and using those crucial robustness checks, like visualizing stability with 3D graphs to find plateaus, not peaks.
Then choosing the right optimization metrics, focusing on risk-adjusted measures like profit factor or CAR-MDD, not just chasing win rate or total return.
Validating adaptability dynamically, using walk-forward analysis to simulate real-world performance and parameter updates.
Never forgetting to include realistic transaction costs, slippage, spreads, commissions, especially for faster strategies.
And finally, evaluating performance at the portfolio level to get that holistic, real-world view of risk and return.
Wow. When you list it all out, it's clear that building a truly robust, back-tested strategy is a serious undertaking.
It absolutely is, but it's this rigorous approach that significantly increases the probability of developing a strategy that can actually thrive, or at least survive, in the unpredictable live markets. It's about building on data and resilience, not hope.
And it's interesting, our source material notes that this kind of data-driven, rigorous approach is exactly what's employed at Accumulation Pro.
Right, the focus there is leveraging these principles, detailed backtesting, robustness checks, focusing on consistency, comprehensive risk management, specifically for their algorithmic swing trading strategies.
Applying these concepts we've discussed to aim for those consistent results in a structured way.
That's the goal, applying this methodology rigorously.
And for listeners interested in seeing how this approach is put into practice, you can learn more about their strategies over at accumulationpro.com.
Definitely worth exploring if this methodology resonates. And now, of course, we must include the important disclaimer.
Yes, please go ahead.
Okay, please remember, all the information discussed in this deep dive is provided strictly for informational and educational purposes only. It does not constitute financial advice, investment advice, or a recommendation to buy or sell any security. Trading involves significant risk, and past performance, no matter how rigorously backtested, is not indicative or a guarantee of future results. Market conditions change, and strategies can fail. Always conduct your own due diligence, understand the risks involved, and invest responsibly. You should strongly consider consulting with a qualified independent financial advisor before making any investment decisions.
Absolutely essential reminder. Thank you. Even with the most meticulous backtesting following all these steps, it's still based on historical data. It's a model of the past.
True. It's the best map we can create, but the territory ahead might still hold surprises.
Which leads perfectly into our final provocative thought for you, the listener, to mull over. If even the best, most robustly back-tested strategy is ultimately just a model built on historical patterns, what do you think is the single biggest blind spot? What crucial factor, perhaps inherently unpredictable or unquantifiable, might still significantly impact a strategy's performance when it finally goes live, something that even walk-forward analysis or including costs can't fully capture?
That's a deep question. What lies beyond the data?
Something to think about as you develop and deploy your own strategies. Thank you so much for joining us on this deep dive into mastering robust backtesting. We hope it's giving you a solid framework and valuable insights.
Hope it is helpful. Always more to learn in this game.
Indeed. Until next time.